Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. Today, I wanted to talk about the 60/40 portfolio and inflation. There's been a lot written about that lately. For those who need a refresher, the 60/40 portfolio just means a portfolio where you have 60% of your assets in stocks and 40% in bonds. That's a portfolio that serves quite a few investors well, particularly middle-aged investors. Let's say if you're between, 40 and 60 or 65, that's often a decent portfolio. Not always, not in every case, but that works. That's worked pretty well. It's been the old standby or default portfolio. If you're younger than that, usually it's worth having more stock exposure, and if you're older than that, it's often worth having less. So that's a kind of default portfolio for a lot of people. The question is, how does it perform in inflationary circumstances? And the answer is typically not so well. This argument is made a lot, but it's not often shown so graphically as I'm about to. So this slide shows the period when we had inflation, 1966 to 1981. The blue line is the 60/40 portfolio line rebalanced annually, and we kept it pretty simple here. Just the S&P 500 for the 60 piece, the stock piece, and the 10-year U.S. government bond for the 40 piece. So simple portfolio. You can see that portfolio keeps up with inflation until about 1972, 73, and then it doesn't. Inflation begins to outstrip it. And over the course of the whole period from 1966 to 1980 through 1981, the 60/40 portfolio loses 1.6 percentage points per year to inflation. I'm just using the CPI here for inflation, Consumer Price Index. That doesn't seem like a lot. You might say, so what? What's 1% a year or 1.6% a year? But I indexed these two lines to 100. So we started 100 for both data series at the end of 65, beginning of 1966. And so inflation, the orange line, gets to just under 300 at the end of 1981. So a basket of goods and services that cost $100 in 1966 costs just under $300 in 1981, or at the end of 1981. The 60/40 portfolio, every $100 invested, you could look at it this way, in 1966, is less than $250 in purchasing power at the end of 1981. So that is a meaningful difference. That is a loss of purchasing power. Your initial $100 invested can't buy what it could buy at the beginning of the period. It can only buy less than $250 worth of that same basket of goods and service that now costs nearly $300. So that's why people talk about the 60/40 portfolio struggling in an inflationary environment. Now, this is only one data point, one period of elevated inflation. There aren't that many to look at in the country where we have good data for stocks and bonds, but it's reasonable to think that another inflationary period could hurt stocks and bonds again and cause investors to struggle to keep up with prices. That's because bonds inherently do poorly in inflation. When interest rates rise, bond prices go down, especially if they're longer-term bonds. And we are using the 10-year Treasury here. I could have made a more complicated portfolio where we baked in some cash, some gold. Gold did well in the 70s. Of course, it did horribly for the next 20 years after 1981. But we kept it simple here. Just stocks and bonds, mainstream stocks and bonds. Stocks tend to keep up with inflation because they can pass their higher costs on to customers. But what happens to stocks when inflation is really running hot is PE ratios compress, as we say in the business. What does that mean? That means the price that people are willing to pay for the most recent year's earnings of a company tends to go down. A compression in that ratio occurs. So right now, if we use a cyclically adjusted PE ratio, the current price of the S&P 500 relative to the last 10 years. Earnings, that's at 40 right now. That's historically extremely high. It's a reasonable guess that if we get a spike in inflation, that people will not be willing to pay 40 times past 10-year inflation-adjusted average earnings for stocks. In fact, that's what happened in 2022, just a few years ago. People have short memories. They don't remember that far back, but we had a very bad year for both stocks and bonds. The S&P 500 was down 18% that year, and the Bloomberg U.S. Aggregate, the main U.S. bond index, was down 13% that year, a very big loss for investment grade or higher quality bonds. And that's because inflation spiked that summer at 9% on a year-over-year basis. So we do have a more recent example than this chart shows of 1 year of bad inflation causing stocks and bonds to go down. I'm not making any forecasts. I'm not making predictions about inflation. The two main arguments about inflation are that, one, the end of offshoring or perhaps some reshoring of industrial jobs and other kinds of jobs will be an inflationary force. That's the argument for inflation. The argument for deflation is that AI will take people's jobs away, lower people's incomes. So that's the deflationary argument. I have no idea which one of those arguments is going to win, or if they'll wind up being a draw and kind of canceling each other out. I don't think anybody knows that right now, but those are the two main arguments. And they seem like reasonable arguments to me. One or the other of those things could happen, or they could wind up being a draw, as I said. Right now, inflation is at around 3%. It's higher than what the Fed wants for some reason that I don't think even the Federal Reserve itself can explain. The Federal Reserve, that is, wants inflation to be at around 2% per year. They think that's reasonable. I'm not a trained macroeconomist. I can't tell you why the Federal Reserve thinks that, but we're above where they'd like it to be. We certainly know that. The president, pretty much like all presidents, wants interest rates to be lower. Whether that will spur inflation or not is the big question, but that's where we are now. We're probably due for one more rate cut this year. It's not, I don't think, a meaningful cut. The 10-year Treasury is yielding 4%. Shorter term treasuries are yielding a bit less. I don't know that 0.25% means a whole lot. This will be the third one that we've had this year if it happens at the end of this month. It looks like we're not going back to 0% interest rates. So that's where things stand. No predictions, but investors should be ready for the idea that if we get inflation, portfolios may struggle. I hesitate to say what might do well. Again, gold did well in the 70s. It's done well the last 3 years, which is really odd because it tends not to do well when stocks do well. No recommendations for that here at this point. No price targets for gold. I don't think anybody can put a price target on gold or silver or either of those metals. So inflation causes stocks and bonds to struggle. That's the theme of this video. This is John Komarianos for Capital Considered, signing off. Thanks for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.